Welcome to Wealth. I'm Allie Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, policy whiplash causing investor fatigue. One portfolio manager explains where to find opportunity and how you can position for the summer. And the majority of Americans are concerned about how tariffs could impact their finances. We have tips to help consumers navigate the current environment. Plus, how does Chase Sapphire Reserve stack up against its competitors? We get the side-by-side comparison later on in the hour. But first, with the Federal Reserve's meeting currently underway, let's take a look at some of the market action 90 minutes into the trading day. Stocks edging higher ahead of the Fed's interest rate decision due out at 2 p.m. Eastern. Joining me now is Zach Hill, Horizon Investments Head of Portfolio Strategy. So Zach, let's start there with the Fed. Interest rates expected to remain unchanged, but all eyes are going to be on the summary of economic projections, that crucial Fed dot plot. What are you expecting to see there? And if we do see changes, what do you think will be driving those?
Yeah, great to be with you, Allie, here as we all wait the 2 o'clock and 2:30 press conference. I think one thing that we're looking for in the S&P is just to see how the Fed marks to market their expectations. And so we do think the growth and inflation revisions are going to be a little bit in the stagflationary direction. And given the overall conservatism that the Fed has acted under, given all the policy volatility we've seen, we do actually think that there's a chance that the 2025 dot could get revised up by one cut. So we're only expecting one cut this year as opposed to two, which is what the last projection was and what's about currently priced into the market. So we do think that initial 2 o'clock reading could be could skew a little bit hawkish versus expectations.
Do you think if it does skew hawkish, markets will fall?
Initially, yes, I do think so, especially considering people are expecting, and there's been a lot of talk, from President Trump and others about, the Fed being a little bit behind the curve and needs to start lowering rates. And certainly the economic data is slowing. That's an objectively true situation that we find ourselves in. So, yeah, I don't think that would be, great for markets. But ultimately, we'll see what Powell says. He tends to be more dovish, actually. And so, we could see a chance for the market to snap back in the press conference. But broadly speaking, I think, the Fed, while it's something fun to war game every 6 weeks, I think they're really kind of a sideline story for the summer, because don't think the June or July meetings are in play. And so, we have Jackson Hole in August, and then the next meeting is in September. So that's a while away. So, broadly, I think the Fed matters less than they have in the past.
So you say that as we head into the summer, markets are really looking for that next macro narrative. And so far, that's been hard to pin down. What do you think that's going to be?
Yeah, I think there are two that are possible. One, is on the trade front. That's been really back burner for markets. Investors are just, quite frankly, exhausted with all the back and forth. And you see that in the market reaction. Things that would cause, a 4% move, in April are now causing a 30 or 40 basis point move in markets. And so, that's one area where there's been a lot of complacency, quite frankly. And so we do have, that July 9th trade deadline coming up. And we had the G7 meeting over the weekend with no progress on deals. And so that's something that could potentially come back to the fore. And the other one, and this is very much in the background, but the fiscal concerns and the actions in Washington around the reconciliation bill. Again, that's something that's gone in and out of favor in terms of the way markets have been focusing on it. But we are getting closer to that July 4th deadline that President Trump set to have a bill on his desk. And so, we do expect to see some news flow heat up around that.
And Zach, you named a lot of risks there, but one you didn't was the Middle East conflict, and that has added a new layer of uncertainty. We've seen some moves in stock, especially oil. But do you think the market is underestimating some of those geopolitical risks?
Yeah, I didn't mention the Middle East conflict, and I think investors' default mode on these things is just to say they don't really matter in the long term. And we're not geopolitical risk analysts. We broadly agree with that. I think there are two conditions where that's a different story. One is if you have direct U.S. involvement in the conflict, that would be a material escalation and something that is definitely going to have to be reflected in risk pricing of financial assets. And the other one that we haven't seen, really in any material way, but would be a sustained spike in oil prices. We did see an initial pop, and now oil prices have come off a good bit. That's something that could potentially really muddy that inflationary picture and just be a strain on consumers that are already, more strained than they have been over the last 2 years. And so those are the two things that we're watching. But broadly speaking, it's not a huge part of the way that we're looking at the calculus right now.
And quickly, when we take a look at some sectors, you mentioned in your notes to us that small caps could have a quick catch-up trade, which has been interesting because they've been pretty quiet so far this year. We've been waiting for something to happen with small caps. So what makes you a little bit more bullish?
Yeah, I mean, this is very much one of those catch-up trades. I would say a rental, not necessarily something that you're going to be looking for over the next 3 to 6 months. But we do have an opportunity after this Fed meeting, goes through. We've seen a lot of weakening in the data, and one thing that we're going to be watching is, do some of the more dovish members on the Fed start to come out and make their case publicly that they need to be cutting rates at some point? And so that's another potential narrative that could catch fire. And if we see interest rates start to come down, especially in the long end of the curve. Obviously, there's some interaction with what's going on in Washington, so you need to pay attention to that. But if you do see long-term interest rates come down, we do think that takes a lot of pressure off of small caps, which gives them an opportunity to work tactically. But still, broadly speaking, given the overall risk backdrop, it's one where we need to be very nimble with that exposure.
Zach Hill, thank you so much. Appreciate your insights. Well, as the Fed announces its decision on interest rates, investors are closely watching the Summary of Economic Projections, or SEP, released 4 times a year. This report shares forecasts from each Fed policymaker on key indicators like GDP growth, unemployment, inflation, and interest rates, famously shown in the dot plot. Now, the dot plot gives investors clues on where the Fed thinks interest rates should go. Since rates influence everything from mortgage costs to savings returns, it's an important guide for financial decisions. But it is also important to remember that these are just projections, not guarantees. Think of the dot plot as the Fed's crystal ball of sorts, helpful but subject to change as the economy evolves. Because the SEP is only released quarterly, it can move markets by shifting expectations on rates and borrowing costs. Still, investors should use it as one tool among many, not a fixed roadmap. Now time for some of today's trending tickers. We're watching Hasbro and Nintendo. First up, Hasbro cutting 3% of its global workforce as a way to trim costs. Out of the toy maker's nearly 5,000 employees, 150 are expected to be let go. Hasbro sources the majority of its products sold in the U.S. from China, which the company is trying to change by diversifying it in other countries. That's all spurred by President Trump's trade war, putting upward pressure on the company while it already sees dwindling demand. Next, Japanese traded shares of Nintendo hitting a record high during trading today as it continues the rally following the release of the Switch 2. The gaming giant's shares have risen 46% year to date, adding an estimated $39 billion to its market cap. In the first 4 days after the launch of its new console, Nintendo sold 3.5 million units of the Switch 2 and estimates sales of 15 million units in its fiscal year ending in March 2026. You can scan the QR code below to track the best and worst performing stocks of this session with Yahoo Finance's trending tickers page. Well, new grads have an employment problem. The unemployment rate's 12-month average for young college graduates, those between the ages of 20 and 24 with a bachelor's degree, was 6.6% in May compared to the national average of roughly 4%. So if the labor market is holding steady, why are new grads getting disproportionately affected, and how can they find opportunities to succeed? Corey Katenga, LinkedIn's head of economics for the Americas, is here to discuss. So Corey, we just talked about some tough labor market stats there for younger workers. What's driving these challenges?
Well, right now, what's really driving the challenge for entry-level workers, for young workers who've recently had a degree, it's the industries that we are seeing that have momentum and don't have momentum. And in the latest jobs report, we saw that pretty much all of the jobs were added by healthcare and leisure and hospitality. And there are some areas that are really fruitful for new grads, but they haven't been doing well, like technology, information, and media, financial services. So we have started to see those particular industries in LinkedIn data level out. Hiring is steady. It's not getting better. It's not getting worse, but it's still well below what we saw prior to the pandemic. So those key industries like finance, tech, professional services, so consulting, legal, accounting, that hire a lot of new grads, they are not hiring that much right now.
So with companies like Amazon cutting roles due to artificial intelligence, how is AI reshaping job opportunities, especially for some of those new graduates?
Well, at the moment, we're not seeing wide-scale evidence that AI is reshaping opportunities in terms of job loss. What we are seeing is that employers are demanding AI as a skill for new workers, increasingly so. So in our list of skills on the rise, we see that AI is one of the top skills. List of jobs that for recent grads that are the fastest growing, it's AI engineer. So companies are really gorging on AI talent right now. So if you are able to interact with AI, be able to evaluate the outputs, or if you're one of those folks who builds and maintain those tools, you definitely have an edge in the labor market today.
So you talked about some of the sectors that are not hiring as much. What about those industries that are currently showing some stronger hiring growth for young professionals?
Education being chief among them. Since about the start of the pandemic, March 2020, we've seen that education has had the most momentum for hiring entry-level workers. Behind that, healthcare. Healthcare and hospitals, another area that's very fruitful. We've seen that our demographics are starting to change. We're aging as a population. So demand for healthcare services is only going to increase. We did see out of the pandemic a surge in demand for those services that since cooled off a bit, along with the broader labor market, but that area just still has a lot of green space.
Yeah, we consistently see healthcare as a top performing sector in that monthly jobs report. But what about cities or states that are emerging as hotspots for new grads?
Well, it's the areas that are actually hot. It's the Sun Belt. So Tucson, for example, is an area where we've seen some of the most growth for recent grads. We release LinkedIn's workforce report every month to monitor what's happening in the U.S. labor market, and it's always Miami that is well above pre-pandemic levels of hiring. So it's really those Sun Belt states and those cities that have had a lot of momentum. So Texas and Florida, Arizona. So those are really the areas that have been very fruitful for recent grads in recent years.
And why is that? Is it just because there is more demand for younger workers there? Is it the types of jobs that they provide?
It's a combination of things. One aspect is the jobs that are actually available right now. There's been a lot of momentum in construction, for example, and that's our top industry that we see in LinkedIn's graduates guide. It's really been construction over the last few years. It's had a lot of momentum, in part because we've had big investments from the Inflation Reduction Act. We also have recovery that was happening because construction had a really dismal 2022, and then there's also the aspect that people are not selling their homes right now because interest rates are high. So housing starts has also supported some building for construction as well. So it's really the industry dynamics that are shaping the labor market for recent grads.
Yeah, interesting, since we have seen that struggling housing market. But what key advice would you give young job seekers really navigating a challenged market right now?
First of all, know where the opportunities are. Which industries have momentum? Which are losing momentum? Where are the areas where people have found success recently? And are the conditions under which they found that success going to continue? So, for example, if you're looking at an industry that's been supported by a lot of government funding, is that funding running out? Are they likely to continue on? So just being able to have that research background and know where's there likely to continue to be momentum, I think that's key. Another aspect is knowing what skills are in demand for employers. How do you feature those and communicate those? So we know that a lot of employers don't know what their AI strategy is, but they want to bring in people who do know how to interact and use AI. So being able to showcase that you have that skill, that you can interact with AI, that you can evaluate the outputs of it. That's increasingly important for new grads to demonstrate. And in that respect, they probably have an advantage over a lot of folks in the labor market.
All right, Corey, great advice there. Thanks so much. Appreciate it.
Thank you.
Coming up, new housing construction falling to pandemic-era levels. What that might mean for the housing market next up. The latest housing starts and building permits data for May coming in below expectations, with 1.26 million new homes started in the month. That's the lowest level seen in 5 years since May 2020 during the height of the pandemic. I want to bring in Jessica Lautz, National Association of Realtors Deputy Chief Economist and Vice President of Research. So Jessica, we've just had this string of disappointing data. Housing starts hitting a 5-year low, builders sentiment weakening. Buyers clearly seem to be staying on the sidelines. So what do you think it will take for this pattern to break?
Well, I think it takes a lot of factors, actually. Labor supply has always been an issue when we look at home building, but also looking at interest rates. Borrowers or builders have to borrow to build. And so we know that higher interest rates are not only affecting housing consumers, they're affecting builders. And we know the cost of goods is really an issue. It has continually be an issue for home builders. And so just thinking about all of those factors together to bring in more supply.
And you were talking about interest rates that trickles through into mortgage rates, and mortgage demand has declined recently, even though rates have fallen, which seems a bit counterintuitive there. So how much is weak consumer confidence driving this drop in both home purchase and refinancing activity?
Well, certainly there are some consumers today who may have taken a step back from the home buying process and said, you know what, let me take a pause and let me actually wait. That being said, when we look at mortgage interest rates, we know that they've been flat for essentially 20 weeks. There's been small movements in mortgage interest rates, but they've been in the 6% range. That's too high for consumers who may be homeowners right now, maybe locked in under 4% and saying, I just don't want to make that move unless there's a motivating factor. We're seeing more inventory come in, but we need those home prices to really be at the point and housing affordability to be at the point that consumers can afford. And when they look at interest rates and they look at home prices, they just say, I don't know if I can make that move right now and make that work.
And outside of mortgage rates, home builders have cited labor shortages, high material costs as major challenges within this market. So how severe are these issues right now, and how much longer do you expect them to weigh on new construction?
Well, it's been an issue for more than a decade now. Really, coming out of the Great Recession, we've been having this issue for a very extended period of time. And when we think about the housing shortage in the US, we know that we're short about 5 million homes. And that's really because an extended period of time that we've had these issues in the US. We need to encourage young adults to move into the trades as skilled labor to bring in that labor shortage. More women perhaps in the trades, not just focused on skilled young men coming into the trades. We need to really expand who we bring in for that labor supply and labor crisis.
And a new survey from Redfin shows that about 1 in 3 baby boomers say they'll never sell their homes. How is this trend affecting overall housing supply and the market dynamics we've seen over the past year?
Yeah, certainly. We know that baby boomers have reinvented everything. So it's not a surprise that they're reinventing aging in place. They're not going to move. And we know that they're the biggest share of home buyers in the last year, too. They have the cash to be able to do so, as opposed to first-time home buyers who are really just struggling with affordability. And so if there's not enough of supply to go around, this is really going to be an increased issue. We can't look at baby boomers as the solution to our housing crisis. We really do need to build more.
And you mentioned affordability concerns. How are you looking at first-time home buyers and the challenges that they're facing?
Yeah, if we look at first-time homebuyers, they're at historic lows, but also their ages are at historic highs. So we know that they're renting for a longer period of time. And this is an issue when we think about the housing market and we think about movement. If baby boomers aren't moving and we can't bring in new first-time homebuyers, we don't have the supply to go around. It's just a very difficult housing market when we think about young adults getting on that first rung.
And looking ahead here, are there any signs or policy changes on the horizon that could help ease some of these challenges for both builders and buyers? What should we be watching for in the coming months?
A lot of this has to do with local conditions too. So thinking about what are the local solutions in your community? Maybe that means adaptive reuse. Maybe that means accessory dwelling units to bring in smaller units. So maybe not just the big single family homes, but thinking of different ways to approach this housing crisis and really bring in young buyers into the market, first time home buyers, and bring in more supply that we critically need.
And what impact has this had on the rental space? Since housing is so high cost on the individual, have we seen this surge in rents?
Yeah, we did back in 2022. Some of that has been abated. We know that new leases, that cost has come down for renters, but we know that rents are still high, and that also has a double effect into the housing market. Because if you're paying more for rent, you're paying more for goods, you're paying more when you think about student loan debt or childcare costs. It's hard to save for that down payment. We know that some young adults are finding a pathway into homeownership by moving in with family, so that can be a way, but I don't know if that's a good solution for everyone involved.
Jessica, thank you so much. Appreciate it.
Thank you.
Coming up, tariffs weighing on Americans' minds and wallets. We have tips to help consumers navigate them. That's next on Wealth. Let's get a check on the market action. You're seeing green across the screen here, with the gains being led by the tech-heavy NASDAQ composite up about 0.5%. The Dow Jones Industrial Average is also up about 0.5%, or roughly 196 points. S&P 500 up 0.4% here. Investors are closely watching any moves from the Federal Reserve. We have that policy decision coming out at 2 p.m. Eastern, along with the interest rate decision. We'll also have the release of the summary of economic projections, which includes the dot plot. This maps where policymakers expect interest rates to go in the future. So all eyes will be on that dot plot here. Investors, in addition to the Fed, they're also closely watching the conflict in the Middle East. And to that point, we're seeing crude oil prices edge a bit lower today. We're below $75 a barrel, which is where we settled yesterday. If we take a look over the past 5 days, you'll see that we're still at elevated levels, but coming down from some of those highs that we saw. And then finally, a quick check here on Bitcoin. We saw the Senate pass the Genius Act that sent the market cap for stable coins to a record high there. And we're seeing Bitcoin prices up marginally today, down over the past 5 days, but today we're up about 0.3%, trading just below $105,000 a coin. Well, roughly 2/3 or 65% of Americans believe tariffs will worsen their personal finances. That's according to a new Bankrate survey. And tariffs are just one of the reasons consumers are feeling down about the state of the U.S. economy. Joining me now is Mark Hamrick, Bankrate senior economic analyst. So Mark, consumer sentiment has been downbeat for quite some time now. First with inflation, now tariffs are thrown into the mix. How are these factors shaping Americans' financial behavior?
Good to be with you, Allie. We're really talking about sentiment here, which can be different from the actual behavior of Americans, including consumers. But that was the focus of this survey, which, as you point out, is all about the fact that essentially a majority of Americans believe the direction of the economy is on the wrong track, and that 2/3 of Americans believe that tariffs will be bad for their personal finances. Let's go back to November. The number one economic issue in the presidential campaign was inflation. You talked about today's Federal Reserve announcement. One of the reasons the Fed will be on hold at this meeting, perhaps next month's meeting as well, is because they are essentially paralyzed, waiting to see what the ultimate impacts are of the president's ever-changing tariffs policy. But we know that essentially it can do damage to price levels, in other words, have upward pressure on inflation, and also can provide headwinds to economic growth, perhaps slow the job market.
And how do you see perspectives differing by age group or political party affiliation when it comes to consumer confidence and spending?
This is perhaps one of the most remarkable aspects of all of this, in the sense of how you feel about where the economy is very much predicated on your political identification. So if we go back to that initial finding that a majority of Americans are unhappy about the direction of the economy, that's almost exactly what we found a year ago. Here's the difference. We have a Republican in the White House now. We had a Democrat in the White House then, as everybody knows. And if you oppose that person with respect to your politics, then you're not feeling great, or that's what you're expressing about the economy. If you're wearing the jersey, so to speak, the team jersey of the person in the White House, then you're a quote unquote fan. And so that's the way the polling breaks down. I would say overall there is a slight decline in the number overall of Americans who believe the economy is on the right track. To your question about ages, younger Americans are slightly more downbeat about the outlook. And I think that probably speaks to both their politics broadly, as well as the fact that, as we know, younger Americans tend to be more financially fragile.
Yeah, interesting how those perspectives shift among those different groups. And we know that prices for shelter, food, they've been particularly sticky for Americans. Where else are we seeing higher or more consistent pricing pressures?
Well, we can talk about those that are sort of keeping the consumer price index at elevated levels. Shelter, obviously, as you say, is one, whether you're paying for a mortgage or rent. The cost of housing also ends up being associated with property taxes, insurance costs. Then the insurance costs if you own an automobile. The price of a new automobile, if you're looking to buy one, is close to $50,000, and prices for used vehicles are expected to go up because of this tariffs issue. The cost of medical care, that's 1/5 of the US economy, can really do damage to a household budget, particularly if somebody has something that's catastrophic. The price of energy broadly has been fairly stable, except for what we've seen with crude oil prices, of course, in the past week. The price of food has continued to remain at elevated levels, and we've only seen that coming down ever so slightly with food at home, but food away from home, going out to bars and restaurants, that's still adding some price pressure there as well.
And with all these challenges here, what are some practical steps consumers can take to try and ease some of that financial burden?
I think one of the most important things that we counsel here at Bankrate is to talk about prioritizing emergency savings. We've said for years now, our surveys that we do, at least on an annual basis, have found that most Americans do live paycheck to paycheck. And in the current, still somewhat high interest rate environment, it's not that difficult. In fact, it's fairly easy to find a high yield savings account that pays an annual return of 4% plus. Number one, focus on essentials. Live beneath your means. Don't live sort of on the cutting edge or the edge of the envelope on just trying to keep up with the Joneses, so to speak. Pay down high cost debt. New offers on credit cards going out there right now for the best qualified users at 20%. That means a lot of people are paying 25, 30% if they're maintaining those balances.
Mark, appreciate those tips. Thanks so much.
Thank you.
Well, JPMorgan Chase unveiling the latest update to its Sapphire Reserve card on Tuesday. The changes include a hefty bump in its annual fee to $795. That's up from the prior $550. But with that extra money comes extra perks, including new credits, free status at IHG hotels, and additional perks after spending $75,000 in a year. So how do these changes stack up against other popular credit cards? For more on that, we have Ben Walker, Yahoo Finance senior credit card writer. So Ben, let's start by comparing this to a card many Chase fans hold, the Sapphire Preferred card. What are the differences here? Because the Preferred card, especially now, the annual fee is a lot less.
Yeah, thanks for having me. I mean, the annual fee on the Sapphire Preferred is $95 compared to the updated Sapphire Reserve, which is $795. That's a difference of $700. So that's the biggest difference you're going to find between these two cards. I would recommend, just in general, or if we're talking about the vast majority of people, the Sapphire Preferred is probably the better card because most people do not need to be paying $795 for a travel credit card. However, if you want premium benefits, including airport lounge access, then the difference, in annual fees could make a lot of sense. The Sapphire Reserve also has a lot of new benefits. However, they could be a little complicated to use. So you have to look at those benefits and see how they align with your travel preferences.
And do you think when the Reserve card was in the 500s for the annual fee, did that make it worth it to choose a Reserve over the Preferred, or are you still a Preferred guy?
In general, still a Preferred guy, okay. But the Sapphire Reserve made a lot more sense for a lot more people when it was at the $550 annual fee. And that's just because the $300 flexible travel credit, immediately cut out a lot of that annual fee. And then you could find a lot of value just by using, the airport lounge access benefits.
Yeah, good point there. Now let's compare the Chase Sapphire Reserve to some other travel cards. First, how does it stack up against the American Express Platinum card?
Yeah, I would say the American Express Platinum card is probably, the easiest comparison for premium travel credit cards, especially with the updates to the Sapphire Reserve and its annual fee. So the Sapphire Reserve annual fee is $795, and the Amex Platinum is actually $695 right now. So the Amex Platinum has a little bit of an edge over the Reserve in that regard. However, they both have tons of travel credits. They both have airport lounge access. You can transfer points to hotel and airline partners. They're actually very similar cards in regards to their benefits. So I think it really comes down to, again, seeing how your travel preferences align with each card. For example, if you prefer Chase Sapphire lounges compared to Centurion lounges, or if with the Sapphire Reserve new benefits, you want that IHG Platinum Elite status compared to the Marriott or Hilton status on the Platinum.
Interesting. And are there certain airline partners that either card has as well?
Yeah, they have specific transfer partners. With Chase, one of the big ones is you can transfer your points to the World of Hyatt program. And that has consistently been one of the most popular transfer partners for getting a lot of value out of your points.
And what about the Capital One Venture X card? How does the Chase Sapphire stack up?
Yeah, just first off, looking at the annual fees, the Venture X has a $395 annual fee. Compare that to the new $795 annual fee on the Sapphire Reserve, and that's a $400 difference. So immediately the Venture X is going to be more appealing to a lot of people who don't want to pay such a high annual fee. I also would recommend the Venture X to more people who want a premium travel credit card because it's just a little more straightforward to use. There is one big downside of the Venture X coming up. They have changes that they're getting rid of the guest access, the complimentary guest access to airport lounges. So that is a big change that the Sapphire Reserve will still have 2 complimentary guests to airport lounges. And that's a big, pro in their favor. But the Venture X still is a more straightforward card. The Sapphire Reserve, really got to look at the benefits, see if you can actually use them every year to get the value out of them. Otherwise, that $795 annual fee, it's not going to make sense for a lot of people.
All right, Ben, you gave me a lot to think about when it comes to my credit card choices. Thank you so much.
Thank you.
Coming up, we're discussing the growth of Formula One racing, brand partnership potential, and the upcoming F1 film with a team principal. That's next on Wealth. Formula One is gaining popularity in the U.S. The 2024 championship reached about 30 million viewers across ESPN's platforms, with an average of 1.1 million viewers per race during the season. Now, the fast-paced sport is taking on Hollywood with the new F1 movie out June 27th. Yahoo Finance senior autos reporter Pras Subramanian joins me now. So, Pras, you got to speak with someone from F1, and obviously this comes at a time when there's a lot of anticipation for this movie, too.
I mean, big time, right? I mean, amongst fans, we're talking about the movie for a long time. I think now it's kind of gotten into the mainstream. People are excited about it. They want to see it. They've seen, that you just saw a little clip of that. High-paced action filmed at actual races, a big deal. So I spoke to Williams F1 team boss, James Vowell. So this is one of the most famous teams in the sport. They were in town to kind of promote the movie. The big premiere was in New York a few days ago. I spoke to him about why this movie is getting so much buzz, what he thought of it, and also sort of the juggernaut that is F1 in the U.S.
I had the pleasure of seeing it in Monaco a few weeks ago. The drivers and team principals were there. Here's how I describe it. It's not a documentary, but it is authentic to us as a sport. Jerry, Joe, and the team were really, really impressive at integrating themselves across 23 and 24, such that, as far as I went, we had an 11th team alongside us. It was really seamless in terms of integration. And for most of those that understand how sort of movies are made, typically you'll get 20 takes. They didn't. You would have one take as we're leaving the grid, and that's your take, and you're going to work with it. And they did impressively well. When you see the final product, really well to integrate effectively into our world across that 2-year period.
We saw footage of the production at different actual races, filming alongside you guys. Lewis Hamilton was a part of the production team, but also shooting a lot in America too. And I want to talk about America here. So F1 effect here has been tremendous. I talk to fans all the time that I never thought would be interested in the sport, following you guys across the globe. How do you explain that sort of the juggernaut of F1 in this country?
Good question. I've seen the same thing you have. I would say probably line in the sand around about 2019, it started to grow and expand. And I'd say in the last 3 years, it's near enough doubling every year if we just look at base numbers in terms of growth. So roughly putting some numbers to it, fan base across the world, over 800 million, fan base in the US, 50 million. But the really important thing is doubling year on year. So great trajectory. Commercially, if we look at all of the partners and sponsors that we have, a third of them are from the US, which just tells you how important it is. And now here's the real kicker for me anyway. We have Miami, we have Austin, and we have Las Vegas. And those three are crown jewels in our calendar. They're the ones that when you go to your partners and say, where would you like to come to? They select those three. And that's just how important I think we've become for each other at that point in time. There's a commercial success, but I think what we've done really well, and it's a combination of Liberty, combination of Netflix, and I think the Formula One film as well, is actually portraying how much of a team sport it is, how much we've got 1,000 people behind the scenes working every hour they can to develop the car, every single race to be different. And it's made us into this product that you can really get behind.
You mentioned Netflix. James, you were one of the stars of one of the last most recent season with the negotiations with Carlos and things like that, bringing on really two world-class drivers to your team. Talk to me about the brands. You mentioned the big U.S. brands. Oracle, people like that. Yeah. This Duracell on your chest, right? How do you? I guess my question is, have you seen that explosion coming on with more U.S. brands in the sport with Williams?
Without question. Fundamentally, if I compare back to us as Williams, there's even names that, you've got Stevens, which is just on the other side, Kraken as well on there, particularly Duracell you've already mentioned, Brilio, which is there as well as a part of it. These are large, mixture of tech and otherwise, but large names that are US based, and they've come on board in the last 12 months, really as part of our journey. Duracell a little bit longer, but fundamentally for all the other ones, they've really joined us and our journey. Now there's two things attracting that. One, Williams is used the word juggernaut. I describe Williams as one of the sleeping giants of the sport. We're still today the top three most successful teams in the sport. We have nine Constructors World Championship and 7 Drivers Championships. And for transparency, that's why I joined Williams. It's this incredible brand, but there's no doubt about it. For the last 20 years or so, we haven't had success. And that's why I wanted to be a part of it. I wanted to have the opportunity with the right investment, which we have from Dalton, to bring this sleeping giant back to the front. And I think this year, the journey is one that people can really start to see that we are serious. We are meaning business. This is a serious bid to start winning multiple championships again. It would just take time. And what we've seen as a result of that is there is commercial success that follows. There are individuals that I'd almost describe as challenger brands in their own right that want to be a part of our journey. And that's really that sort of meshing together that's working brilliantly well.
So he mentioned some U.S. brands like Duracell is a big sponsor for Williams, but also Doralton Ventures, which is a big VC firm based in America. They're the big equity owners in Williams. So you're saying not just brands, but professional money, all kinds of happening because the sport is just growing so much and people are just sort of getting on board, especially in the U.S.
Yeah, it's crazy the fan base for this sport. I'm wondering if you think this movie is going to attract maybe new fans after they go and watch it.
Why not, right? Because I'm still amazed that the Netflix effect, the show Drive to Survive, brought so many fans. Now look, there was a captive audience. We had pandemic. People were stuck at home and they thought, what is this sport? What is this show on Netflix I can watch? And they binged it. And then people started watching the actual races. So why wouldn't the movie maybe catapult a bit more fans on board? I mean, maybe we've already hit critical mass, I'm not sure, but I don't see how this is a bad thing. The movie seems, from what I hear, the movie's very exciting. It's really good. It's not very realistic from like a racing fan point of view,
It's
but
not
hey,
authentic though.
I'm willing to check my fandom at the door just to have a fun, movie, popcorn movie in the summer.
And we have Brad Pitt. Who doesn't love Brad Pitt in any movie? He's great in everything he does. I'm excited. I'm excited to see it. I think we're going to go see it together.
Yes,
I'm excited.
we are.
Love it. Go F1.
Yahoo outing.
Praz, thank you so much. Appreciate it. Coming up, a new hardware partnership that could mean big things for the video game world. We've got the details. That's next. It's time for Tech Support, our weekly deep dive into all things technology. And this week, could a new chip maker be attempting to dethrone gaming giant NVIDIA? AMD and Xbox announcing a new hardware partnership for their upcoming consoles. Yahoo Finance tech editor Dan Howley is here to break down what we know so far. And Dan, how big of a deal is this for AMD?
It's a big deal, right? Usually what happens is these companies come out and they say, okay, we have an agreement to produce a console, right? But that's not what Microsoft and AMD are announcing here. They're announcing the next generation console, the next generation Xbox for the home, and then the next generation of handhelds, and then anything else, really. They kind of made it very broad, saying it's a multi-year agreement. A lot of this ties back to Microsoft's want to get consumers to use its Game Pass service, which is its online gaming service where you're able to download games, stream them from the cloud. Actually, it's shocking how well that works, and get access to as many games as you want that are available there. It costs between $9 and $19.99 a month. Not a bad amount of money for what you're getting. And instead of a one-shot where you're buying a console, you have recurring revenue from Microsoft over years and years as people continue to use it. So that's kind of where this is going. But this idea that they're expanding beyond just the home consoles kind of puts a pin on in that, because you have this console at home, and then you'll have this portable console to take with you, and then you'll have whatever else they decide to cook up down the line. And it's just it's showing that, okay, Microsoft is ready for its next generation of consoles. Obviously, it's huge for the company, but Microsoft hasn't sold as well, the Xbox hasn't sold as well as Sony's PlayStation, which is just blowing it out of the water, or Nintendo Switch. So we'll have to see if they can turn that around. But I think for Microsoft, as I said, the big deal is Game Pass. I mean, they spent $7.6 billion or something on ZeniMax Media. This is where they want people to go.
And I'm curious if you think this partnership is enough to dethrone NVIDIA's, position in the video game marketplace.
I mean, NVIDIA's huge on the PC side, and there are more PC gamers than console gamers in the world, just by virtue of the fact that there aren't consoles available everywhere, or they're just too expensive. So I still think that NVIDIA is going to have, a huge lead in that market. Microsoft is, though, putting its console games on PCs and its PC games on consoles, so it's moving back and forth between them so that it's not kind of segregated between the two markets. So it could benefit AMD in that respect. They already power the Xbox now. They power the PlayStation right now with their custom chips. NVIDIA's got Nintendo, though, with the Switch. It sold gangbusters. The Switch 2 just sold out. So, I mean, it's hard to see if AMD is going to dethrone them. But, when it comes to graphics power and games, it really is still NVIDIA's market.
Got it. And while I have you here, Dan, President Trump expected to sign a third extension of the deadline for the TikTok ban today. Should U.S. users, should they notice any interruptions there? Full steam ahead?
No, I mean, it's like, I don't know if you watch Lamb Chop's Play Along, but this is the song that never ends, right?
Yes.
Sherry Lois, shout out. This is just going to be kicked down the road again and again and again, I think, until they eventually reach a deal. It seems to be tied to the U.S.-China trade agreement, and that's really, I think, where that's going to go. We won't have anything until then, most likely. It's a big chip in China's corner.
Good point.
No one's going to notice anything different, though.
All right. Thank you, Dan. Appreciate it.
Sure.
Let's do a final check of the markets here. We're still seeing green across the screen. The NASDAQ composite leading gains up 0.6%. Investors are awaiting that Fed decision out at 2 p.m. Eastern. We will also have a press conference from Fed Chair Jerome Powell coming at 2:30 p.m. Eastern. Any signs or clues about where interest rates could be heading, that's going to be closely scrutinized. And beyond the Fed decision, we will also be receiving that summary of economic projections, or the SEP, and that maps where policymakers expect different economic indicators to be heading in the future here. But for now, that's it for Wealth. I'm Allie Canal. Thank you so much for joining. Stay with Yahoo Finance all day for coverage on the Federal Reserve's June meeting. We'll bring you the decision live at 2 p.m. Eastern, followed by Fed Chair Jerome Powell's press conference at 2:30 p.m.